Hello and welcome to Ask for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Buy now, pay later playbook. We talk about the growing trend that is consumers paying in installments for their purchases, and we're joined by a Wall Street analyst who can name the players you may want to consider having in your portfolio. And stocks closed the day near the flat line as Wall Street looks ahead to retail earnings and commentary from the Fed on interest rates. Yahoo Finance's Jared Blickery is going to be here to break down the top trends of the trading day. And Homebuilder sentiment has fallen to its lowest level since 2022. Yahoo Finance spoke to NAHB CEO Jim Tobin about the state of the industry, and we're going to bring you those comments as well. Well, buy now, pay later isn't just a payment method anymore. It's becoming core to the Fintech strategy, and we're navigating how to play the buy now, pay later trade amid rising adoption in a higher interest rate environment with the Yahoo Finance playbook. Joining me now, we have Dan Dolev, Senior Financial Technology Analyst at Mizuho Americas. Dan, it is always great to see you, especially on set.
Thank you.
Let me start big picture. BNPL, buy now, pay later. Give us a sense, Dan, how big is this market at this point, and how fast is it growing?
Great question. So, U.S. retail, we're talking U.S. e-com is about $1 trillion business. Buy now, pay later today is probably pushing like 70, 80 billion. It's tiny compared to e-com, and it's even smaller if you think about total U.S. retail, which is like 7, 8 trillion, right? So it's big, it's growing fast, but it's still a very small fraction of the overall opportunity.
Who is using buy now, pay later? Do we have line of sight in there? I'm prompted a lot to use it, but do we have any kind of line of sight to just the average demo, Dan?
Yeah, so what's interesting is it's got the reputation of being steered more towards like people that don't have access to banking, et cetera, but it could be anyone.
That is the rep, for sure.
That is the rep, right?
Yeah.
But I think it's a little bit misunderstood because remember, during COVID, everyone was buying Pelotons on a firm. And that was like your neighbors, right? It wasn't only people that don't have access to credit. So I would say it's mostly skewed younger. So if you think about it, this like 18 to 34 cohort, kind of right where I am, just kidding. That 18 to 34 cohort, younger, and I would say just younger. I think there's a preference. I wouldn't say necessarily not as wealthy, more younger. And that's the key thing. Young people don't trust credit cards, don't trust banks. This is a very big lure for young people.
Let me ask you this, because we talk on the show about concerns about the macro and whether the economy could get kind of weak here. To the extent that the economy does get wobbly, Dan, that would mean what for BNPL, the industry and the players?
So the rep is it'll go bust.
Right.
Right? So we hear that all the time, right? I'm an analyst, I cover all these names. The rep is like it's never been tested in a bad macro. We think about this a little differently. Because it's never been tested, it could go both ways. And one of the things to consider is that it could be somewhat counter-cyclical. And let me explain. The reason it could be counter-cyclical is because it helps companies make conversions. So it helps e-com retailers sell something they couldn't sell using a regular credit or debit card. So if the macro turns south, there is a possibility that merchants are going to want to convert more. So they're going to basically steer consumers more towards buy now, pay later. So there is we've never seen this before because it's a new industry, but it's just as equal or just as likely that it would be counter-cyclical and thrive during a worse economic environment.
Let me ask you this, as the BNPL market grows, Dan, what kind of risk, what kind of challenge does that pose to other names you cover, specifically the credit card names?
So it's really, as the buy now, pay later market grows, it really mostly hurts the banks. So the banks, like the JP Morgans of the world, et cetera, because they are the ones that are extending credit today. It does not really hurt, say, Visa or MasterCard because all these BNPL transactions are actually getting settled using debit. So they're actually turning one transaction, like Visa is turning one transaction into 4 because you have to pay like 4 times. And Visa makes money off of every transaction. The real short end of the stick is coming to the banks. Like they're the current incumbent credit card operators, like the banks, basically.
Let's get some picks, all right? Give people some opportunities, some names. Affirm, you say, is still a buy. Stock's up about 30% this year. Why is it still a buy here, Dan?
The TAM is unlimited and the execution is epic, right? So you don't often get that sort of
Max
combination.
Levchin's execution is epic.
It's max execution, right? There's literally like 2 or 3 companies in our space where you have that perfect marriage between a great idea, great execution, and product velocity. That's Affirm and Robinhood, right? Those are the 2 names that you could basically say they've got it all. And when you talk to Max, he just tells you, I'm all about taking risk. And I think that's the key differentiator between them and Klarna, right? Compared to them, Klarna looks pretty pale, right? Klarna, which is the other big...
How so? How does Klarna look pale?
Because they're mostly doing buy now, pay later or pay in 4, whereas Affirm has a plethora of different offerings. They can do pay in 4, pay in 6, interest bearing, non-interest bearing. Underwriting those is much more difficult than underwriting sort of the basic pay in 4 that Klarna does. And so if anything, let's say gets weaker as the economy goes south, if it does, we don't know. Right now things are great. It would be sort of the more simple pay in 4. So Affirm has still a lot of like future potential because of that specializing in this like interest bearing loans, which are the key, the hardest thing to underwrite.
What about PayPal? You say that one's a buy here too. Now that one, we're down about 20% so far this year. What are the catalysts that move that one higher?
So it actually ties everything goes back to sort of buy now, pay later, right? Like everything is sort of, so buy now, pay later, and I'm actually really glad you asked it because buy now, pay later is part of the new branded checkout button. And so as buy now, pay later grows faster, right? And their plans is for buy now, pay later to grow in the 40s over the next 2 to 3 years. That should actually accelerate the branded checkout button growth. And by the way, what I'm hearing is they're crushing Klarna in Europe.
Crushing Klarna.
Crushing.
Yeah.
Merchants are rolling out the red carpet in front of PayPal in Europe.
Interesting.
And so as this does better, the branded checkout button is going to accelerate because it's part of it, right? They're offering like a much better value proposition, right? They don't put you on some sort of a marketplace. They don't charge you affiliate fees. So merchants love it, and that's why they're gaining share.
I have to ask you this one last question, my friend.
Sure.
I think I have this right. I think you only have, Dolev, one underperform. I think you only have one sell. It's Circle. How come Circle is a sell? Isn't this the great way to play the mega trend of stablecoins?
I had to, it's a sell, but it's like a sell with passion. It's a very passionate sell.
The best kind of sell,
It's
really.
the best kind of sell. I'm very excited about this sell opportunity. It's so special.
Excited about an underperform.
And it's so special that
it.
I have one of them, right? It's sort of like, it's like gold. I treat it like, they get a very special treatment in our little franchise. I tell you, the one fallacy about Circle is like rates go up, go down, their revenue goes down. The distribution of USDC, which is how they make money, is basically flat at $68 billion. It literally only moved like 10% since April, right? And distribution costs, which is what they have to pay to Coinbase, Binance, God knows all these apps that are proliferating the USDC, is actually is getting worse and worse over time. So you're getting basically like a confluence of different forces. There's almost no chance that revenue is going to be what people think it is by the end of the year. I mean, unless you think that rates are going up and that they're going to gain share from Tether, which is not happening. So basically 1 minus everything you think, that's what's going to happen with Circle. So it's a very passionate
underperform, passionately buy on Affirm though, I think. Is that fair?
Exact inverse.
Exact inverse. Dan, great to see you as always, my friend.
My pleasure.
Stick around, much more As for a Trend still to come. U.S. stocks closing the trading session a little changed as Wall Street seeks clarity on Ukraine talks and the Fed's rate cut path. Here with the train day takeaways, we've got Yahoo Finance's Jared Blickry. Jared.
Well, thank you. We got to talk about what's going on in August, and some days you just don't see a lot of action in the major indices. That's what we got today.
Did you say listless? Because that's how one strategist, he said
listless, doldrums.
Yes.
Look at this. Dow down 34 points. I mean, this isn't 1980. 34 points is nothing, guys. NASDAQ Composite up 6.8. S&P 500 barely, almost flatlined right there. So where are we seeing some of the action? You have to go into specific stocks, but I keep saying that when you have a boring bull market, that's what investors actually should hope for, because that's when you make the most returns consistently day after day. You don't have to keep your eye on the market at all times. Here's what happened in the sector land. XLY, that was a great, you don't have to know what this is, but the greatest performing sector was only up 0.4, didn't get anything to the downside of 1%. I did highlight at the close some interesting sectors that have kind of revived recently, or maybe industry groups, I should say. Clean energy, this is because of some initiatives by President Trump, not as bad as people had feared. And a very similar reaction happening in the cannabis space. And we've seen this perk up recently. And these are double-digit movers a lot of days just because they've been so beaten down over the last few years. I'll show you a chart of Tilray. Let's do a max real quick, and you can see that is from the upper left to the lower right if you exclude just a few bars there at the lower left. So basically down 96%. So that kind of tells you the story of where we are. I got to get into cannabis and solar to find where the action is.
And volatility, by the way, on the way? Is that what you see?
It depends on where you look, because bond volatility has been cratering, but we do have stock volatility maybe picking up. And so let's get to the VIX, because I love talking about volatility here. That's always interesting to do. And we'll actually start with the MOVE index. I was talking about bond market volatility, and that's what the MOVE index is. And there we go. And I'll put a year-to-date chart on. And you can see we had this spike up. This was around Liberation Day. That's also when the VIX spiked up. This is just showing that bond market volatility is dropping. That's a very bullish thing in general for risk assets. And you'll see this is the lowest point on the year. And I think, let's go back 3 years. I think it's the lowest point in 3 years. So very low volatility in the bond market right now. Conversely, what's happening in the VIX? Well, it's still pretty low. This is a year-to-date chart. You'll remember the other one looked fairly similar. We're not quite at the lows of the year, but if I do put on a 5-day chart, you can see we inflected up a little bit on Friday. We're still up a little bit from those prior levels that we saw last week. And if you look at the VIX to the VIX, that is the third or fourth derivative of movement in the S&P 500 stocks, something like that. That is more elevated right now. But I do want to show a chart that I showed last week, and this is the expected path of VIX volatility throughout the year. So this white line goes from January through December, and this green line is what has happened so far this year. This is a huge aberration. That Liberation Day, nobody saw that coming. History can't account for that. But what you want to concentrate on is right now, from basically August into the end of October, that's when volatility tends to rise. And so that means we have the potential in August, late August, September, October, to see some more market movements. And when we do, we're not going to be saying we wish for those boring bull markets. Maybe we will.
Finally, it's Monday.
Yes.
Should we talk crypto?
Yeah, let's talk crypto, because crypto whiffed. Couldn't find any major headlines or market moving news, but sometimes crypto just does this. I'm going to start with some charts of Bitcoin and just kind of show you the price action here, because Bitcoin and some of the other markets in crypto have done something that they tend to do quite a bit, which is to fake traders out. And let's put a year to date with some candlesticks there. So you can see just a few days ago, we peaked above these prior highs right there. That sucked in new traders. And then we had a big down day. And in fact, if I put a 10-day, you can see how big that was. This caused some pain, and now we've just been moving lower. Not to say that the trend is going to go lower from here, but just to say that crypto in general can be a very tricky market, and this is something we've played out time and time again. I do want to show you this. Bitcoin versus the NASDAQ 100. We've been seeing a very tight correlation between these risk markets, and just want to show you that the QQQ, this is the NASDAQ 100, pretty close to record highs. We've seen Bitcoin diverge a little bit, so it's off of its high more than NASDAQ 100. And here's something, I just noticed this a few minutes ago. Bitcoin versus MicroStrategy, or it's just strategy. This strategy tends to be a levered play on Bitcoin, and you can see it was trading at a multiple at these highs here. It has come back down and met Bitcoin. When it's done this before and traded under Bitcoin over long periods of time, that is an indication that the crypto cycle has been rolling over. Not to say that we're at the end here of Bitcoin's bullishness, but I will be watching this very closely in the days to come.
Thank you, buddy.
You
Appreciate it. Stick around, much more Ask for a Trend still to come. Homebuilder confidence fell to its lowest level in 3 years. Weak buyer traffic and ongoing supply side challenges continue to act as a drag on builder confidence. Yahoo Finance got the chance to speak with Jim Tobin, CEO of the National Association of Home Builders, to speak through the current state of housing. Here's what he had to share.
I get to travel across the country and visit our builders in every part of the nation, and definitely over the last couple of months we've seen a slowdown, and it's all about the rates. To paraphrase Bill Clinton strategist James Carville, it's the rate stupid. It really is these kind of persistently high mortgage rates that have really constricted the market over the last 6 months, and we're going to continue to see that until the Fed starts to cut and send a signal that inflation is under control and the market should start to react, hopefully.
I mean, we've seen mortgage rates come down a little bit, right, Jim? I mean, how much are they going to have to come down to sort of loosen everything up?
They've got to be a lot closer to 6 than they are to 7. And yes, they have come down over the last couple of weeks. But again, it's been very bumpy this whole year and last. We kind of get these runs where we are closer to 6 than 7. And then we get back up closer to 7 than 6. And so I think that home buyers want to see a consistency in mortgage rates, and we just have not had that consistency over the last several months. So until then, borrowers are going to remain cautious.
So in your view, it sounds like mortgage rates coming down could help solve the demand problem. But what about the supply problem, Jim?
Well, until those rates come down and we see buyers come back into the market, builders are going to slow the pace of construction, plain and simple. Like I said just a minute ago, it's time for the Fed to cut, and that will help twofold. One, it'll send a signal to the broader markets. Even though the Fed has an indirect result on mortgage rates, what they can do through lowering their own rates is they will send a signal to banks that it is time to start cutting the construction lending that is the lifeblood of this industry. And so if the Fed actually cuts, I think we'll see lending rates for construction to go down. We'll see more folks get back into the marketplace, in which case we'll see production tick up. And then we have to get our state and local governments to actually help us build more housing by removing those regulatory barriers that continue to be a thorn in the side of developers everywhere.
Of course, if the Fed cuts, it's not going to do with the housing market. In other words, that's not their job. Their job is not to cut to help housing. Their job is to cut focused on their dual mandate of inflation and the labor market. So from that perspective, it does seem like there is some debate in the markets and among economists about whether the Fed should be cutting at all in September.
I think that we saw the unemployment rate. We saw the jobs report just a couple of weeks ago. Core inflation is coming down. We know that. And 50% of core inflation has been shelter inflation. Core inflation right now, 2.7%. Shelter inflation, 3.7%. Yes, there are policy initiatives that the White House and Congress can take on the supply side. And we actually saw that with a piece of legislation that came out of the Senate Banking Committee a couple of weeks ago. So we are excited about some policy. We're talking to the White House consistently about what they can do from the regulatory perspective. We've got the One Big Beautiful Bill that is now law. That will help add to the certainty of the economic situation in the country, but also builders' confidence and hopefully homebuyer confidence as well. There are some headwinds still in front of us, but I also believe that we are starting to see the fuller picture of this economy. And now the Fed can signal further that inflation is under control and that they can start cutting rates. And that should translate into lower mortgage rates, but also a better feeling in the economy that it is time for people to get off the sidelines and invest in housing.
Jim, what about the cost of building for your constituents, right? What are we seeing in terms of, the tariffs and their effect on building costs?
Builders are reporting about 60% of their goods have gone up, but it's marginal at this time. I'm watching what other economists are saying, that the true effects of tariffs we won't see them until probably next month or even the month after. So tariffs have been really priced in. As I talk to our members, we've seen suppliers raise their prices on the threat of tariffs. So tariffs they've muddied the water, but I don't think they've had as big an impact as we even thought 6 months ago. I think that story is still yet to be written. It really is about that regulatory environment at the local level to help us build more houses. But also, materials are they're going to stay low because demand is low for home building at the moment.
Well, but at the same time, when you look at things like tariffs on steel and aluminum at such high, why don't you think it's showing up more?
Well, again, it's just the data that we're seeing, and my feeling is that it's because the pace of construction has slowed, so therefore, material prices are going to come down because demand is not high at the moment. Another example, other than aluminum and steel, is lumber. We actually just saw the U.S. Commerce Department raise anti-dumping and countervailing duties on Canadian softwood lumber, which is 25% of the U.S. lumber supply in the United States. We saw them raise those cumulative tariffs up to 35%. So those will start to take effect and start to bite as we get into the fall season. So there are headwinds out there, but again, it's because of the pace of construction that we haven't seen that real spike in building material prices yet.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.